Good morning.
Morning.
Okay, welcome back to our class. Okay, so I said that we're going to do maybe one more question, and I think I have one question I've been able to spot. Okay, the same process, by the way. Okay, the same process that whatever you did in the past. Okay, in the morning class. Okay, is what even the examiner here expects of us. Okay, so this question is in page 48. Page 48, okay, a company called CSZ Company. Okay, page 48, a company called CSZ Company. Okay. Okay, so I propose that we have done part A together. I think this one we did. Is it? We have done part A together. CSZ Company, page 48, 49. If I remember, I think we have done part A together. Just to confirm. CSZ Company, page 48, 49.
Yes, we did it.
Yeah, I think we did this together. Okay, so we can do B, and I think we can do C, maybe. I think we can do B and C. Yes. Okay, so go through it. Okay, we do B and part of C. CSZ Company, page 48, 49, part B, part C. Okay, let's suppose that you've gone through the question. Let's attempt to read together. So we've been asked here, calculate the target quick ratio, okay, and the target ratio of sales to net working capital as at the end of the March 2015. Analyze and compare the current assets and current liability position of for 2014 and 2015. Okay, that's the only part you can do for now. The part of discussing working capital financing policy may be out of scope for now. Okay, so let's see. We need to get the quick ratio and the sales to net working capital, and that is as at March 2015. Okay, quick ratio, we do need to get the current assets of the company minus the inventory. Okay, we divide by current liabilities. If we told that the company has a target, okay, has a target current ratio of 1.4 times, I think from that we can be able to work backward. Okay, because we have here the current liability consists of two: trade payables and overdraft. Okay, trade payable and overdraft. So let's get the current assets of the company is made of inventory and the receivable. Okay, so we do need to get the inventory, we need to get the receivable, and after that, so we can be able to determine the company current liability position. So let's begin here. We get the current liability, we get the current assets of the company, the inventory, and the receivable. Okay. Okay. Okay, let me open my writing area. Okay, so the current ratio is about 1.4. So let's get the current assets, the inventory, the receivable. Okay, so we can begin by getting inventory of the company will be equal to the target number of days between the inventory is 60. There was 60 out of the number of days in a year, which we have not been told how many days to use. So you leave the 65. What do I prefer? Okay, this 65. Let me say 65. We multiply by the sales by the cost of sales, and the cost of sales for the year ended that first March 2050. The company has forecast sales will remain at 40, while the cost of sales will fall 6% of the sales. So here we can do cost of sales will be equal to 60%. Will be equal to 60% of the sales, which in this case is equal to 40 million. Here, therefore, cost sale equals 24 million. Okay, therefore times 24 million. Okay, therefore, how much is the inventory? Investment, that is. You get how much? You do it quickly.
39.45.
3 million. 945.
945.
The way it is on the screen, 945,000.
Yes.
Okay, great. Let me get it for the inventory investment equal to 9 million, 3,945,000. Okay. Then next you can get is the receivable. The receivable, it will be equal to the days for receivable, 25. Out of the total days on the year, that is 25,000. We multiply by salesman on credit, which in this case is equal to 24 million. Okay. Therefore, how much was the company invest towards the receivable?
Why is it not 40 million for receivables?
Sorry, 40 million. Oh, sorry. Thank you. It's 40 million. Sorry, 40 million, not 24 million. 40 million. Sales on credit is 40 million. Thank you.
It's 8,219,000.
8,219,000. Okay.
Yeah.
Great. So that's for the receivable. Okay.
So
Now,
we're rounding off, yeah?
I would propose that you don't round off.
Oh, so then the first one will be 3,945,205
Okay.
for inventory.
For inventory, for receivable.
For receivable, it's 8,219,178.
178. Okay. So maybe
Yeah.
because between you will be as much as possible in the workings. Don't round off. In the final answer, you can do the rounding off, but in the workings, try not to round off. Okay. So we get for that to be colorful to be the receivable. Okay. What else? We can done. We can get therefore the current ratio. To the current ratio of this company, current ratio, which is equal to 1.4 times. Is it 1.4? This should be 1.4. Yes.
So what about payables?
We can also do the payables, but it won't help us in getting the current. What we want to get is the current liabilities. For now, that is. For now, what we need is get the current liabilities. Okay. So you can do the payables, but it won't help you out in getting the current issue. Okay. It is part. You can do it as part of the working, but I actually don't see how it is going to help us. Well, the question is asking us to get.
So, but for current liabilities, what figure are we using then?
That's what I want to get, because if you look at the question, you're being asked to get the company target quick ratio. Okay, so there's nowhere you may want to get the payables or even the overdraft. Okay, it might not Anyway, I'll show you so that it becomes more. It will make more sense. I'll show you. You can do the payables, but it would add in the value.
Okay.
The analysis. Okay, so let's do it. Yes. Okay, current ratio is given as current assets of the company. Okay, okay, what's the total of inventory? Inventory is inventory. The inventory, okay, plus the receivables, because that will be the total current assets of the company. You get how much?
12 million
164. So total assets, total
383.
1 million or 12 million.
12. 164.
164,000.
And then 383.
383 then for the company total current assets. Current ratio is 1.4. Therefore, 1.4 is equal to current assets. The figure between there, 12 million, 164,000. Okay, 383. We divide by current liabilities. Therefore, the current liability of the company is equal to, therefore, 12,164,383 divided by 1.4. Because how much? 8 million.
$8,688,845.
688. 845. Okay. Now we have become therefore the company current liabilities. Now the question, let's going back to the question. We've been asked to get the quick ratio. Okay. Therefore, quick ratio, which is given us current asset of the company minus inventory. So the current asset, I'm just represent as CA minus inventory. We divide by current liability, let me represent as CL. Okay. So don't forget the inventory is made of only two. Okay, the receivable and the inventory. So of course, therefore, what's the main here is the receivable. Therefore, the quick ratio for this company is equal to current assets less inventory. That is 12,164,383 minus inventory. We get back to the receivable value. Therefore, 8219. So it will be equal to 8,219,000. 178. 178. Okay, that's kind of for the current assets less inventory. Okay, we divide by the current liability, which you have just obtained here. It was how much? 86, 88, 845. 86, 88, 845. Give us 0.95. 0.95 times. Okay, and that's kind of for the target current ratio. You see the reason why maybe you could have done the payable, but it is not going to help you out in getting the quick ratio. So you don't need to, in quotes, okay, take extra time doing the payable because it is not going to assist you in getting the answer in answer. Okay, that's why I never did the payables. Okay, but you can still do it, but it won't help you out. Okay. Oh, well
Yes, sir. I just read the. I was just doing the quick asset ratio directly, without. I thought that to get the current liabilities, we get the payables, and the payables figure will be the current liabilities.
No. By the way, thank you that because you brought it up. Okay, you have to be very careful. Okay, with that assumption because it's not always the case that the payables is only made of the current liability is only made of the payables. You have to be very careful with that because you may have cases where the company has overdraft. Okay, I think you have seen that in the past. So be very careful. By the way, don't go to the conclusion that the payables value is a current liability value. Okay, so be a bit cautious there because you're going to end up with the wrong answer altogether. But it's good that you have brought it up right now. Okay, that's good. Question? Okay, no question. So the next part of the question, what was it asking us to do? Okay, target quick ratio, you're done. Then target ratio of sales to net working capital. Okay, sales to net working capital. So that's going to be next working. Sales to net working capital. So sales okay, to net working capital. Net working capital. The ratio is just as it is, okay, suggesting, okay, therefore it will be equal to sales of the company divided by net working capital. And the net working capital is current assets minus current liability, okay? And the current asset, we got 12 million something. 12, 164, 383. 164, 383, okay, minus current liabilities, okay, which in this case you need to work in for it. We got 86, 88, 845. 86, 88, 845. Therefore, that's they have give us therefore the company net working position after the increment, okay, after as at 2015. To give us how much? To be the company net working capital 3 million
475, 538.
475, 538.
Yes.
538. Therefore, the company net working capital. Therefore, to get the ratio, so you want to get therefore sales to, okay, sales to net working capital will be equal sales, which is 40 million, the target sales, divided by the net working capital, that 475, 583. To give us how much?
11.5.
1.5 times, okay? Now, what does that mean? It means, therefore, that for every dollar of sales, the company, for every dollar of working capital investment, okay, the net working capital, the company invests towards the working capital, okay, it has been converted into $11.5 of sales, okay? It has been converted into $11.5. So, or the other way around, you can try to say that the working capital required, okay, the working capital required to support for every dollar of sales, okay, let me put it, for every $11.5 of sales the company has to achieve, the company to invest $1 towards the working capital, okay, because it's an investment, okay, it's net working capital investment, net working capital investment, okay, that the company, if the company is intending, okay, to achieve the sales figure, okay, for every $1.5 of sales the company is intending to achieve, they must invest $1 towards working capital. Okay, that's what the sales to net working capital ratio imply. Okay, which means therefore, if the company, maybe assume if for example we have company A, this is company A. Okay, let me just extend the question. Okay, this is company A, and you have another company B here. Okay, let's say it has the ratio being 20, and the average for the industry. Okay, this is the industry. So these are two companies, and the average for industry is, let's say, 15 times. Now, what does it mean? We assume that the industry is like the optimal, what the company should be at, okay? Therefore, this company A, okay, it has a ratio, sales to net working capital 11.5. Now, what does that mean? It means the company is underutilizing its working capital, okay? Because as per the industry, every dollar of working capital ought to support $15 of sales, but now it's only supporting 11.5. The company therefore is underutilizing its investment towards working capital. That's for company A. For company B, the company is excessively utilizing working capital. Okay, the company is going too thin. Okay, if you have to use that term. Okay, the company is going too thin. It is overspreading the working capital. Okay, the working capital ought to be $1 working capital ought to be supporting 15, not more, not less. Okay. If it is now supporting 20, then you are overstretching. Okay, it's like a rubber band. Okay, it is meant to stretch until 15, but now you are stretching until 20. Okay, that's not to be the case. Okay, if you stretch it in quote, okay, to 11.5, then it is not yet at optimal. Okay, therefore 20 is not good because you have overstretched the company working capital. It should be supporting only 15. Then it might break in quote actually. Okay, it might end up breaking. So in scenario B. Okay, so you have to like sort of stick around the industry average values. Okay, is that clear?
So repeat the A1.
For A, the company, you have seen that for every dollar, okay, it's like a swing. Okay, this swing can be able to support, let's say, 100 kgs. Okay, they can support 100 kgs. So if the same swing is going to be supporting maybe a kid of 10 kg, What does that mean? It means it is not utilized, this string is not being utilized to its maximum, okay? It has more potential, okay, of being able to hold 100 kgs, okay? But now it's only holding 10 kgs. So this sort of underutilization of the investment, okay? The same applies to working capital. This company is underutilizing the working capital investment, okay? In scenario B, this string can support 200 kgs. It can support 100 kg, but now what's the weight has it does have is holding. It's holding 200 kgs. It is way above its limit. Now what will happen? It will break. Okay, the same case applying the company. That if this was to continue for a long period of time, the instantly it might not be the best scenario. It might end up breaking. The company might end up becoming either liquid as time goes by. Okay, because you are overstretching your working capital. They should be supporting 15, but now they're supporting 20. Is it clear?
Yep.
Okay, great. Okay. So that's on part A.
So,
Yes.
so we're basically trying to figure out how well we're using the working capital in terms of sales.
In terms of sales, in terms of supporting sales, yes. But now, okay,
Okay.
it hasn't asked you to do the comment, but you can still do it, okay? There's no problem for you to do in the comment, okay? But you can still do it, okay? Because I think for this question, it's simply calculate. But in case it was discussed, then you have to mention that case, okay?
Okay.
Great. Part C, analyze and compare the current assets and current liability position for company as at March and 2015, okay? So we compare the two cases, 2014, 2015, okay? 2014, 2015. So let's do our analysis. Now for 2014, okay, and let's do 2015 because you have the figures here for 2015, okay? So this is for 2015. Okay, current assets of the company for 2015, we got what? 12 something. We got, yes, it is. Okay, 12 and 464. So let's do, so current assets of the company for 2015 is 12 164. 8383, 383. Current liability for the same year, 8688. So I want to compare those two, 8688, 845, I guess. 845, yes, 845. Then for 2014, okay, the position was, how was it like? 2014, the company had a total current asset of 12,275,000. Okay, the liability was 68,189. Because we're going to the net working capital, okay. Here we got something, we got net working capital here, how much? That 475, 475, 583, 583. Okay, 2014 was how much?
$19,094,000.
We are subtracting, so sorry. Forget you're subtracting because you want to get the net. Okay, subtracting.
Oh,
Yeah.
5,456,000.
56,000. Okay. So don't forget here, if we are to make a simple comparison, is that if we even do a further analysis, okay, the company current analysis. So first we can see, okay,
It's 456, not 7.
456.
Yeah.
456. Okay, 456. Okay. Now, if you do a comparison, is that the company net working capital is decreasing. It might not be the best thing, okay, that the company working capital is decreasing, okay. Now, let's see what will the contributor, okay. So first, the company current asset was a decrease, was it is decreasing. A decrease of how much? Was a decrease in company current assets, okay. So we can do the ratio, a decrease of how much should be a very minimal decrease.
1,980,417.
Okay, 9 million. So actually, okay. 1 million. No, it can't be 1 million because which should be both 2015 is 12 million, 2014 is still 12 million. So it is decreasing, but it should be
It's 110,617.
yeah, so 110,000. Also, it is decreasing, simply subtracting actually.
617.
So 190. So one what? 110,000.
110.
Mm.
617.
617. Okay, so you'll see the decrease there. Okay, so okay, the best is what is the percentage decrease? This should ultimately even be better for us. What is the percentage decrease in the company current asset? It should be 0 point something actually.
0.9%.
0.9%. Okay, so therefore the company current asset is decreasing by 0.9%. Okay, now let's see. You can see here in the case of the liability, they are increasing from 6 million to 8 million. So what the percentage increase in current liability? This one is decreasing. What about liability? What's happening? What's the rate of decrease? Increase, sorry, rate of increase.
1,869,845.
Okay, in percent, you get how much?
Let me check.
Percentage increase?
27.4%.
27.4.
Yeah.
24%. Okay, so you can see here is a problem with this company. Okay, because its current assets have decreased by 0.9%. However, its reliance on short-term finances, although this is for short-term finances, current liability, its reliance on company short-term finances has increased by 27.4%. Why is that the case? There is a problem somewhere the company need to resolve. If maybe the current assets decrease by 0.9% and the current liability decrease by the same rate, then that can be more or less considered, hey, they seem the market is not doing well. However, your current assets are decreasing by 0.19%. The current liability are increasing by 24%. That's it's too huge. You can't say that maybe the 2015 is worse. Okay, the company to see how do we manage our short-term reliance on short-term finance for financial finance. Okay, well, there's a huge reliance. Okay, because last year, compare last year and this year. Okay, the increase in your reliance on short-term finance sources is 27.4%. That's true. It's a huge increase. Maybe in case the company current assets were increasing by 27.4%, and that might not be a problem, okay? Because the increase in current assets is being financed by the increased current liabilities. But now this is can you see there's a contradiction, okay? That your need for finance is decreasing. Because you can see, look, this is the need for finance, the current asset, okay? It has decreased. However, your reliance on finance, short-term finances has increased. Okay, it doesn't make sense. Okay, so that here, this company, there is a problem. They need to see how do we manage, therefore, our current liability, our short-term finance sources. Is that clear?
Sir, could you please repeat?
Okay, let me repeat. The company, the need for capital, the need for short-term finances is how much? It has decreased. Don't forget, the need is a current asset. That's what you need the current liability to finance your current assets. Okay, so the need has decreased by 0.9%. Okay, because there's a decrease in company current assets by negative 0.9%. However, the company reliance on the short-term finance sources, okay, has increased by 27.4%. So where is this money going to finance? It means maybe this money is coming to finance other operations, okay? Maybe finance the company, to finance maybe the company, maybe to finance the company non-current assets, okay? Because it does not make any sense, okay? That your current assets are decreasing, but your current liability is increasing, okay? Why is that the case? It means there's a problem somewhere as a company. Either there's mismanagement, okay, of the company finances, okay. What else could be the reason? Or either the company cannot be able to obtain long-term financials. That's why they're using short-term financials to finance themselves. But there is a problem here. Okay, that's the conclusion. is a problem the company needs to solve in terms of the management of its short-term finance sources. Is that clear?
Yes.
Okay, great. Okay, yeah, because as I say, don't forget this should more or less like go at the same rate. Okay, if one decrease by 10%, there should be decreasing. Okay, but if the two there's a huge difference, then hey, what could be the problem here? There's a problem here in this particular company for sure. Okay, is that clear? Don't forget, we can't answer the next bit of the same question because we have not discussed on the working capital financing policy, which of course would make more sense. Okay, but you haven't answered that particular second part of the question. Okay, because discuss how the working capital finance policy would have changed. Okay, so that's the first bit of the question we can be able to answer so far. Is it clear?
Yes.
Okay. Question? Okay, no question. Great. So let's go back to our notes. Okay, so forget that's how the question in most of the time will be asked. Okay, it's quite unlikely good for the examiner asking you. Okay, get a quick ratio, get a current ratio. That's the end of the question. Okay, so the examiner might take it a bit further. Okay, asking you to do the analysis. Okay, like you've done in those past examples we have done together. Okay. Now, the next bit I want to discuss is what would happen, or rather, is it possible that the company might be mismanaging, okay, the working capital? Okay, could that be possible? Yes, there is. It's possible. Okay, the company may end up mismanaging its working capital. Okay, called the outcomes of working capital mismanagement. And the first outcome is called overtrading. Okay, if you mismanage your working capital, then one of the outcome of in quote your wrongdoing, okay, your working capital mismanagement is referred to as overtrading. Now, what is overtrading? Now, overtrading is a case where, as a company, you are intending, okay, to achieve too much sales, okay, too quickly without enough supporting long-term capital. Okay, don't forget, if you want to achieve sales, then what do? You first you have to take you have to take care of your working capital. Okay, at the same time, okay, you have to invest towards long-term assets. That was for sure. Okay, because how do you expect to produce more, okay, or to make more sales, okay, without investing in long-term assets? Okay, you have to. Okay, how do you produce more? You have to. Okay, and the best way to look at how the company is financing towards their long-term assets is mostly through the long-term capital sources. Okay, so the sales you have achieved, okay, have they been supported by an equivalent investment, okay, or equivalent long-term capital, okay, to finance the company need for long-term asset investment? Okay, if it is not being supported, then there's a problem somewhere. Or maybe, okay, there may be an increase in company non-current assets. However, they are being financed by short-term finance sources, like the case you've just mentioned there. Okay, but the company, the case you've just done right now. Okay, the company non-current assets are decreasing, but the company borrowings, short-term borrowing, are increasing. Why is that the case? Okay, could it be that the company is maybe financing its non-current asset using short-term finance source? That should not happen. If you're not going to finance to buy a motor vehicle, okay, that is going to have a life of 10 years, there's no way you can finance using a 2-month loan. Okay, you have to match. Okay, called the matching policy. Okay, you have to match the two of them. Okay, if the need is for 10 years, then match the 10-year finance source. Okay, so this outcome, if the company is attempting to achieve too much sales, okay, too quickly, but they don't have enough supporting long-term capital source, okay, then that is what we call overtrade. You are trying to, in quote, punch beyond your what would you call it? That term. Okay, you're trying to punch beyond your weight, beyond your level. Okay, you're going too high. Okay, in quotes. Okay, so you need to check. Otherwise, in case this continue, okay, then of course you may end up collapsing the company. Okay, it's good to have the ambition to get to have more sales, definitely. Okay, however, it needs to be sustainable. Okay, like that's that. If I use that term, okay, it needs to be sustainable. Okay, so we're trading in that outcome where the company is attempting to achieve too much sales too quickly, but they don't have enough supporting long-term capital. Okay. This results the company in short-term borrowing in form of short-term bank loans and overdraft to finance the company high activity levels. Okay, I think I mentioned that. Okay, that you end up trying to resort to financing your needs using more of short-term finances as opposed to using trying to match. If it is short-term need for capital, you finance using short-term finance source. If it's a long-term, you're trying to invest in non-current assets, then finance using non-current using long-term finance sources. Clear? Now, what in most of the time, from the experience, the examiner is going to be asking you carry out analysis on a company and determine whether this company is overtrading. Now, what do we do therefore in that case? We need to know first of all what are the symptoms of a company that is overtrading. Okay, if you look at the symptoms, these are the symptoms of a company moving trading. Can we be able to draw a conclusion that this company is overtrading or not? Okay. So the first symptom I think you already mentioned is that there's going to be a rapid increase in the company's sales. Okay, so that means for sure that the company, for example, has achieved high sales level, but it's beyond its, let's say in quote, its level. Okay, it's too much. Okay, you should not be doing it. But the companies are doing it. Okay, they tend to achieve too much sales too quickly, but it does not have enough supporting long-term capital. Okay, the first symptom. Rapid increase in the company sales turnover, okay, and by implication, the long-term finance source, okay, the increase in those is very minimal, if any, okay. So here, increase in a very high increase in company sales, okay. However, there's very little increase in company long-term finance. Where is it? Not here.
Is it the third point?
Third point, where is it? Small increase. Here it is. Yes, thank you. That point. Okay, small increase in company equity capital as well as the non-current liabilities. Okay, the long-term debts. Okay, so there will be a very small increase in company equity. Okay, as well as very small increase in company non-current liabilities. Okay, mostly the company debt capital. Okay, those are the two first symptoms. Okay, don't forget from definition of the term itself. Okay. Rapid increase, that overtrading is an increase, a rapid increase in company sales to an extent that the company might not be able to sustain that increase. Okay, the company might not be able to sustain that increase. Those are the first two symptoms. Okay. However, as mentioned, now since the company has seen those two high sales volumes, high sales numbers, okay. However, you don't have the long-term capital. Now, how do you finance the need? Using more of short-term borrowing. Okay, as you can see, therefore, they'll be financed using trade payables and overdraft. The trade payables will be increased very high. Okay, the company current liabilities. Okay, the company short-term providers of finance are the one that will be financing this company's need. Therefore, there'll be a very high increase in these two finance sources: the payable as well as the overdraft, as well as the short-term loans. Okay, that therefore our third symptom. Okay, so first you see that sale will be increasing, long-term capital will be very minimal, the increase will be really minimal. Okay, to finance the need, okay, because you're not financing using long-term, you finance using short-term, then there'll be an increase in the company finance sources. Okay, it will be an increase in company short-term finance uses. Okay. Now, since the company, is attempting to achieve the higher sales levels, how is it going to be achieved? You have to entice your customer, to come and to buy from you. How do you entice them? By giving them, for example, high discounts numbers, giving them better number of days better in quotes, compared to your competitors. So if your competitor are giving 10 days, you give them 40 days. Now, if that's happened, the days are increasing. What happens to the receivable? It'll be increasing. Okay. Therefore, since the receivable is increasing and your sales are increasing, what happens to the inventory? Invest more towards inventory. Then again, they have to have an excessive investment towards inventory, towards receivable, towards work in progress. So the company will be investing more towards the customer through sales on credit. Okay, it is not be cash. It will be more towards the receivable, more be on credit. Okay. Therefore, here, this is the second point here, increase in the company current assets. The inventory, the receivable, okay, cash might increase, but quite not as high as the increase in the receivable and the increase in the inventory, okay. Because you're not selling more of sales on cash, but on credit, okay. That's why the cash, therefore, is not going to be increasing in line with the increase in the other current assets, the inventory and the receivable, okay. Now, since the current assets are increasing and the current liability are also increasing, what happens there to the liquidity ratio? If you remember, one of the ratios that you have said that you can use in evaluating the company liquidity position is the use of quick ratio and the current ratio. Current ratio, current assets, the current liability. The two of them are increasing. However, the increase in the denominator, which is the current liabilities, is much greater than the increase in company current assets. Now, what happened therefore to the ratio? Does it increase, decrease? Let me repeat, just in case you didn't get it, okay? Here, the company current assets are increasing. The company current liabilities are also increasing. However, the rate of increase in current liabilities is greater than the rate of increase in current assets. What happens to the current ratio? Do they increase or decrease?
Decrease?
They'll be decreasing. They'll be decreasing, okay? Therefore, in case you have to evaluate the company current ratio, okay, they will be decreasing. The company liquidity ratios will be decreasing. That includes the quick ratio as well as the cash ratio, the quick ratio as well as the current ratio. There will be decrease in the company liquidity, okay? Which is this point, okay? So here they will be decreasing. The company liquidity position will be decreasing. These ratios will be decreasing, okay? And maybe this is what I mentioned regarding the company equity capital as well as debt finance. Okay, the last could be a scenario where the company current assets, okay, are lower than the company current liabilities. Okay, it can happen. Okay, they have what chance of liquid deficiency. Okay, and the company ought to have positive. Okay, don't confuse. Okay, don't forget there's some company that by their nature they'll be having more of current current liability and current assets. Okay, maybe so the case of Safaricom. Okay, however, the nature of this company is it ought be having a positive, more of current assets than current liability. But now this becomes worse off to an extent. It becomes therefore having a negative position, but it should be having a positive position. Clear?
So what's the difference between current and quick ratio?
Current quick ratio is simply that in the case of quick ratio, we remove the inventory, we remove the illiquid part of the current asset component. Okay, then don't get here current, let me call it ratio. Because you see the current asset of the company divided current liability. Okay, that's the current ratio. Now quick ratio, okay, don't forget we are removing the inventory to be current assets on the company minus inventory, we divide by current liabilities. Clear?
Yeah.
So that's on the question.
Yes. So we say that current ratio and quick ratio will be decreasing.
They'll be decreasing,
but
yes.
it won't be decreasing. But it won't be decreasing by a big proportion, right?
It may increase by a big proportion. Okay, it depends from case to case. Okay, what should be happening is that the company may have a case where the decrease is too much to an extent. The increase in company current liabilities is much more than the increase. It's greater to a further extent, such that the company may be becoming what we call illiquid in terms of its chance of being able to pay its maturing obligation. Okay, chance where the company current assets becomes lower than current liabilities. Okay, but the key observation is that there will be a decrease in the company liquidity. Okay, the extent to which maybe 2% or 90%, okay, might be subject to discussion. However, they'll be decreasing. Whatever the case it is, there'll be a decrease.
Okay, thank you.
It's clear. Now, for these symptoms, don't forget you have to know the symptoms because the examiner is going to give.
Yes, it's clear.
Okay, so don't forget here you have to know these symptoms because what happens as far as you're going to see some of the questions here, what the examiner is going to ask you, you're going to be given some set of financial statement, and out of those set of financial statement, you're meant to analyze and you draw a conclusion based on the analysis you've done, based on the symptoms you have gone through and analyzed. Okay, what can you say about this company? Is it over trading or is it not over trading? Okay, so you have to know the symptoms. Okay, otherwise you can't do that question. There will be no symptom to give to you. Okay, for example, okay, let's go through one of the questions that the examiner has asked in the past. Okay, a given company set of financial statement is upon you to do the analysis. Okay, based on this set of accounts. Okay, between this year and this year. Okay, what do you draw? What was the conclusion? Okay, on this company? Okay, so you have to do the analysis, discuss, and give the conclusion. I hope you're able to note all those symptoms. Okay, great. So let's go through your examiner. Don't forget, one of the ways to understand your examiner is through the question bank. The other way is examiner's report. Okay, which I know that all of you have at least. Okay, do you know where to get them? Okay, and as well as you have done some of the questions there. You have been able to go through them to understand where you can fail. Okay, or where the student normally find a bit tough. Okay, so don't forget, you also need to understand the examiner from the examiner's report perspective. Okay, so I hope you normally do that, or you will do that. Okay. So there's a question that maybe I think we can do on this analysis. We'll check whether I can get it. Okay, so we're given a set of financial statements. We are meant to carry out the analysis and we advise the company. So let me hope we can get it. It's here. Where could it be? There it is. Page 70, page 71. A company called Krago Company. Page 20, page 21. A company called Krago Company. 2021, Krago Company. Okay, so go through it. We answer the question. The question is asking us, evaluate whether the company can be considered to be trading and discuss how what can be overcome. Okay, so simply you try to do the analysis and you inform the company, you told the management, hey, you may be running into the risk of overtrading. Okay, so you're meant to do the analysis based on the symptoms that I've mentioned to you. So first go through it, and the next 1 minute we discuss it together. Page 70, page 21, a company called Krago Company. Okay, I hope you have gone through the question and you have understood what the examiner requires of us. Okay, let's attempt to do it together. Okay, it's a new area. Okay. So as mentioned, the easiest way of doing this question is by going through the symptom, each one of them. Okay, you do the analysis, you analyze. Okay, so get analysis is half of the marks, discussion the other half. Okay, so get used to doing the discussion. Okay, because that's where the half of the marks will be. Okay, so in the first symptom, can be in the first symptom. Daisy, what's the first symptom? Daisy, what's the
Increase in
first?
sales.
Increase in sales. Begin. Therefore, first working is sales increase. Okay, we do for those 2 years. Okay, 20. I'm not sure which year this 2014, 2015. I don't know.
Yeah.
Okay, great. 2014, 2015. Okay, therefore between 2014 and 2015, we need to get the sales increase, which is equal to 17.1 million over 12 million. Okay, minus 1 in percent. What do you get? You get someone is talking like, but I can't hear them.
42.5.
42.5.
Yes.
Okay, you are too far for the mic. So 42.5%, therefore the increase in sales. So we go as if we have to go as far, the first symptom is that there's a rapid increase in sales in the sales figure. Is this a small increase or this a rapid increase in sales? Anita, can we deem 42.5% to be rapid sales increase? Kent has issue with an internet. Nafisa, what do you think?
I think it's rapid increase.
Look, this is a huge increase. Any double figure is a rapid increase. That's a very high increase in sales. Okay. So therefore, the first symptom concurs with, it is one of the symptoms. It concurs with one of the symptoms of overtrading. Okay, that we have a rapid increase in sales. Don't forget, this is 1 year. Okay, this is very high. Any double figure increase or growth is a high increase in the company's growth. Okay, so therefore this concurs with the symptom of overtrading. Okay, so therefore there is rapid. Okay, don't remain analyze, discuss. This is analysis. Now discuss. Okay. Okay, there is a rapid increase in sales. Increase in sales. You can use your own words, okay, provided it's simply trying to discuss the increase in sales. Increase in sales between 2014 and 2015. Rapid increase in sales for 2.5%. Okay. Okay, where should I put this? Rapid increase in sales. Okay, I want to put the figure here. 42.5%. Okay, between 2014 and 2015. That's the first symptom. Analyze it, discuss. Okay. And 2, what's the second symptom?
Increase in current liabilities.
Increase in current liabilities. Okay, so there'll be increased company current liabilities. So that means, therefore, we do need to get increase in current liability or financing for short finances. Okay, so this is short finance increase. Because short-term finance or current liability, whatever you want to call it. Okay, short finance increase. These are the symptoms. Let's do the analysis and then do conclusion. Now, between 2014 and 2015, 2015, the payables, let me begin payables. Payables, okay, they increase they increased by 1.9 million divided by 1.25 million minus 1 in percent. We do the same for overdraft. For the overdraft, okay, it is equal to 2.4 million divided by the figure for last year, 850,000 minus 1 because we do it in percent. Payables increase.
52%.
52%. That's a very high increase. 52% is a very high increase in payables. Okay, overdraft, I think it'll be when we worse. Overdraft is how much?
%182%.
192. It should be actually be okay, 1 and 2. Okay, 1 and 2%. Okay, so get that for 1 and 2%. Now that's a very high reliance on the overdraft financing. Okay, to me that's the company reliance on the overdraft. Okay, went like threefold within a year. Okay, from 850 2.4 million. Okay, so the increase is 192%, a very high increase in the company overdraft freelance. Even for the payable, okay, it increased by 50%. But to make it worse, okay,